All right, everyone. Welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer. The views expressed by my co-host today are their personal views, and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode. All right, everyone. Welcome back to another Bell Curve Roundup. Today, you've got me and Vance, which I think most people would agree was the strongest two of the show. Anyway, yeah, exactly. I'm not getting dragged down by those other two that always are just freeloading, just riding on our coattails.
Feels nice to have two big squares on the screen versus four.
Exactly.
Real estate to work
This
with.
is so nice. Maybe we should reevaluate, honestly, the whole rest of the dynamic here. All right, let's get into it today. Actually, I love where we want to start here, talking about credit. So I'm going to actually just turn it over to you. People who are following along on video can get this helpful visual here, just looking at Genesis active loans quarter over quarter. But can you just kind of tee it up? Why do you want to start this conversation talking about credit, and what are we looking at here?
Yeah, so I think a lot of the stuff that I've been doing is taking stock of 2021, 2020, seeing where things made sense in retrospect, seeing where there was a lot of credit created, seeing where firms like Three Arrows took that credit and used it. And I think it helps you understand both the past, obviously, but also more likely the future and where things are going to go, because some of these things will be in the market cycle next time, a lot of them won't, and it'll just have a different type of impact on the market as we know it. And so I think there's kind of three steps to this. The first is, how much credit was there in the aggregate? The second is, who did it go to? And then the third is, what was it used for? And, we don't have all of the answers on this stuff. A lot of it is unknowable. These are private companies, but you can kind of start to piece together a little bit of what went to who and what was it used for. And, just starting the discussion. This is free form, but this is a good place to start. So on the screen right now, you have Genesis active loans by quarter. And Q4 2021, they had about 12.5 billion outstanding. And that was not the high watermark. It actually went a little bit higher to about 14 billion in Q1 of 2022. And so let's start with, this, call it $14 billion number of credit. And if you look at this chart, which is a super fascinating research piece put out by Odessa Cap on Twitter. I have no idea who they are, but this is good research. It's interesting. There's 14 billion of credit. More than half of that looked like it was USD, but about half of it was Bitcoin and ETH. And so let's start with that 14 billion number. There was a report that the Wall Street Journal released this month that said that at the height of the amount of credit that was created, 6.5 billion of the Genesis active loans were to Alameda. And we'll get back to who was using this, but let's start with this $14 billion number. $14 billion from Celsius. BlockFi's Q2 2022 transparency report, they had 1.3 billion in loans. Roughly double that, so that we are, at the peak of the credit creation in 2021 to take us back there. So call it 2.5 plus 14. So we're at 17.5 of total credit created. Voyager in their bankruptcy filing, 200 million to Alameda, 700 million to Three Arrows, and 100 million to 200 million to others. So that's another billion. So we're now at 18.5 billion. Let's call the Babel Finance, Hodl-Not, blockchain.com bucket, one. Let's say that was another billion. So we have 19.5 billion of credit. And then you have the FTX situation where they were selling user assets to pump their own coins. Call that credit as well. And I think that's around, 3 to 4 billion. The point of this is that you get to, 20 to 22 billion of aggregate credit that was created in the market during 2020 and 2021. The credit market is completely dead today. You literally cannot borrow dollars from anyone except for maybe Maple. But they're still kind of rebuilding and doing their thing. But that's a lot of credit. And so just let's stop there. Mike, any questions or anything like that?
Yeah, well, honestly, one of the things that I don't know if you're
kind of planning on getting into this, but like one of the things that also stands out to me at looking at this chart here is this enormous green area, which is USD, like dollar-based lending. And it seems like, based on what I know purely about the Genesis situation, it seems like that's actually where they got into an enormous amount of their trouble, sort of as well. There was a really great thread that sort of came out about this, which was, if you look at, US dollar credit creation, how it works in the rest of the world, it's like that happens at the level of, commercial banks. And commercial banks have like all these advantages, right? First of all, they have enormous balance sheets. They have that window with the Fed, right? There's like FDIC insurance. But on top of that, like even their prime brokerage desks and stuff like that, there are all these like tools and systems and processes and communication channels that have been built up over the years. And honestly, just watch it. I'll see if I can find the tweet thread and link it, which gets into more detail. But just watching, when you look at this big green part of the chart and you saw Genesis trying to enter into this business, my thought is just, it was like, wow, they're really taking a knife to a gunfight, and they were just pretty ill-equipped at trying to participate in the business this is obviously where a lot of their revenue is being generated. So that's a huge takeaway for me looking at this.
And like this, the growth of the chart is crazy too, right?
Crazy.
You can see how this went from something that was manageable, a small cottage industry of, microloans to, one book alone, 14 billion and 15 billion in credit from just Genesis. I mean, that's pretty wild.
Yeah. So where did this end up getting used? Like, how much can we piece together about because I sort of have my own little theory about this, but like where have you been able to piece together, like where was all this credit kind of going?
So I do think, and just to back up, I do think there's an intermediate question here, which is what was being lent out as credit? About half of it was US dollars, but the other half was Bitcoin and ETH. And if you're a market maker and you get Bitcoin and ETH, the first thing you do is sell it, put on a hedge if you have to get it back, but you need US dollars to do your work. You can do kind of crypto collateral on different types of levels, but that's pretty hard for market makers. So that's one other thing to keep in mind. So the numbers to remember, 20 to probably 22 or 25 billion of credit was created in 2021 through all of the venues. And where did it go? Alameda. So let's just put that one out there. There was a Wall Street Journal report that said there was 6.5 billion of outstanding loans that were given to Alameda just from Genesis at a single point in time. And so that's greater than 50% of their loan book at any given point. And so you can kind of imagine Genesis giving them a few billion of USD, a couple billion of Bitcoin, a couple billion of ETH. They sell the Bitcoin and ETH. They go off and market make, do whatever they need to do. And that loan was eventually called. So, Alameda has 6.5 billion from Genesis. They have at least another 200 million from Alameda. And they probably have, another billion or 2 billion or so just from other sources and uses. Most specifically, the FTX collateral that was stolen and probably sold and then used to buy the other assets. So I'm calling it at least 10 billion of credit was given to Alameda. And you think about that, that's a big number. And where did it go? Probably a few different places. And we'll get into that. I have an answer there. So Alameda, there's 20 billion, 25 billion of total credit. Alameda gets about half. Three Arrows. Let's talk about that one. The week that they got called, the data that was put out, and they got margin called and they got blown up because they couldn't meet their credit obligations. They had 3 billion in loans from Genesis. They had 700 million from Voyager, 700 million from BlockFi, and probably another few hundred million from blockchain.com. They probably had 5 billion in credit. And so if you think back during 2021, you had Alameda with 10 billion. You had Three Arrows as like a slightly smaller, more scrappier competitor, but they had probably 5 billion. Between those two, you're talking about 66 to 75% of the entire credit market was just from them. And you look at Genesis's statements that they put out, Alameda was their biggest counterparty. It was about 33% of their loan book. Three Arrows was probably 20%, but the figures match. You're talking about roughly 15 billion of credit between those two. And so the question that I get to is like, where did the other credit go to? Yeah. There's 20, 25 billion, 15 billion is Three Arrows and Alameda. Directional hedge funds, probably pretty small. Mining, that's probably another one. And then maybe the GBTC trade, that would be the third place. But really, you're talking about the entire market encapsulated, 75% between two people. And that's just wild to look back on.
100%. And it, It's funny because like Three Arrows has now blown up. I mean, it feels like a lifetime ago that those guys blew up, but there are these like commonalities in between. First of all, just to like reiterate what we've talked about on the show a million times, Kyle's and Sue's explanation for how it's not their fault still just gets to me at my core. They're like, no one could. Their big thing was, oh well, we didn't know that people would follow us into this trade despite publishing, that they had like $1.5 billion of outstanding GBTC in, going to a trade. So there was that. But a lot of these guys ended up getting taken down by a pretty similar mistake. And honestly, even though, so a huge part of the market was like these two entities that you're pointing out. But honestly, Three Arrows Capital, DCG and Barry, Alameda all kind of did the same thing. They had a horrendous duration mismatch. Whereas they had a source of financing that was supposed to be geared towards like longer term, less volatile risk taking. And they use that to lever up and go super long shitcoins, which is good when shitcoins are going up. But then when the market turns and now like DCG, I'm sure this is what's being talked about behind closed doors at DCG. It's like, how do you get liquidity on that? And that's like what happened with Three Arrows. It's what happened with, Alameda was kind of a whole different thing, but kind of honestly same thing with Alameda. And then DCG is, I think, facing that same exact problem.
Right. And they had kind of the same symptoms and ultimate diagnosis of just being dead. But how they got there was two different ways. Like if you look at how they got the leverage, Alameda printed the FTT token. They used, and this is all public information, they used it to collateralize the loans. And, if you think about that relationship where FTT is really the whole thing that's propping up the empire, Barry says, I want the loan back. You can't really say anything else. What's the alternative? They just sell FTT into the market and collapse everything. And so it was not surprising in retrospect to see that loan actually got paid off in the summer, whereas they probably just extended the duration on everything else. And then if you think about Three Arrows, how they probably got the leverage was different, right? It was the GBTC trade, which is kind of the self-encapsulated trade within Genesis, where Three Arrows comes up, they buy GBTC, they pledge as collateral, they get more loans, they buy more GBTC, they pledge as collateral, and so on and so forth. And in that scenario, it's kind of the opposite, where Barry now has the token that is underpinning his empire, GBTC, and if that really gets panic sold, there's a different scenario. And so a lot of the Three Arrows claims are, Barry just liquidated us to steal our GBTC. And, who knows if that's right or wrong, but you can kind of generally assume that Barry really wanted to protect that GBT from being sold on the open market, because that would really hurt, a lot of his business. So it's kind of different paths, but it's just interesting to think about the power dynamics of the relationships between, the lenders and the borrowers and how they each got there.
100%. Although I do think, to be fair to Barry, there's much more like GBTC is more legitimate as an asset than FTT, which was
you more nothing. To hang on there. You also created it, so like there's some rules around what you can do with it, but it's just interesting nonetheless. And so the last part of kind of like this analysis that I wanted to do, mostly for myself, just understand what happened, is how did these people use the collateral? So these are just like round numbers that I'm guessing at, but there's 25 billion of credit that no longer exists in the crypto ecosystem that used to. Alameda's VC portfolio, that's 5 billion, right there. That's what they use that for. They probably use another 2 to 3 billion on FTX and FTX exchange operations, marketing, personal loans, things like that. Those figures roughly match. There was likely about 2 billion spent supporting Sam coins, in my opinion, 2 to 3 billion. That's a lot of money, especially if you're levering perps up with it and you're really charging against people in a no liquidation context. And so that's another one. And that's kind of like the Alameda bucket. And that adds up to 10 billion. But it reminds me of like this old saying, like, how did you lose all your money? It's like, well, I spent the first third on like booze, women and fast horses, and the rest I just squandered. Like, they did squander a good portion of it just on these stupid marketing things and all like that. But the rest of it was used in ill-advised VC bets, trying to prop up ecosystem coins. The thing I want to drive home on how Alameda used the funds is that was very self-contained within the Solana and the Solana ecosystem and the FTX ecosystem. Like, you didn't really see Alameda going long ETH or Bitcoin or GBTC, like they were spending money to make money within their own ecosystem.
So is the long-term implication for that then basically mechanically then in the market there was basically a lot of sell pressure, sort of artificial sell pressure coming from the Solana FTX part of the ecosystem on kind of the core assets of Bitcoin and ETH, sort of artificially propping and a lot of artificial buy pressure on kind of the Sam coin ecosystem. Is that the takeaway, and you would expect that to kind of reverse moving into this new regime, or what's your sort of takeaway from the analysis?
I would say that, the 2 to 4 billion spent on Sam coins is probably something that you don't really see again. I also think the 5 billion that they spent on just like VC style bets and propping up ecosystem token, or like doing all the venture rounds for all the ecosystem tokens, like you probably don't see that ever again. Like the VC presence of setting the floor on Solana projects was a phenomenon that, just blew my mind, where everything that was raising private money on Solana was like 2 or 3x more expensive than ETH. And you probably don't see that again, but I think the takeaway is, it's there's going to be just less of a bid on Sam coins, and like, that playbook of having this massive ecosystem fund really won't work again. Just the credit won't be there. So that is what FTX did, and like, they were big Solana backers, but that was really, their game. You look at Three Arrows, it's mostly the same story, but it's a little bit different. They were, Sue still has the red triangle. So he's long AVAX. He did all those deals with Luna. I think it was like $1 billion plus of deals with Luna. And so if you think they have 5 billion, maybe that's like 1.5, 2 billion of money that they spent there. They did Near, they did Mina, they did the GBTC trade. The things they didn't do were the majors, honestly. Like they didn't put net buy pressure onto Bitcoin or ETH. Like it was all used within these relatively self-contained ecosystems. And so, I think the long and the short of it is Ethereum really didn't get much or many of these flows. And I think that will be different next time going forward. But mostly, and not to harp on this over and over, you can kind of tie the source of funds to how they were used. And I can just see these all L1 ecosystems really taking a hit as a result. Like you're going to need large ecosystem funds to support them. And I just don't know if they're there anymore.
Yeah. I want to actually get back to the point of ecosystem funds. There was an ecosystem fund that was announced this week. I'm not sure if you saw it. Yep. And I think it's actually very confusing how these things are phrased, because it's not like $160 million was raised for this ecosystem fund. So I would be great if you could explain like mechanically how this stuff works. But I have a question before we get there, which is how would you because like the big story this week, right, is like, and I know I know you were on the Bankless pod this week and they were asking you about this, but is like this Aptos sort of run here. So if we're looking at this in terms of like, okay, there's sort of this artificial buy pressure that's propping up and injecting capital that into these sort of contained L1 ecosystems, and ETH and Bitcoin flows were suffering as a result. Like that dynamic so what you might expect to see in the reverse dynamic is like Bitcoin and ETH outperforming, but actually the things that have performed the best, right, are some of these like alt-1, like Aptos is like running away and now has a valuation that's tied with Zoom. So like how does that square basically with this?
I mean, you can generally say that like it doesn't make sense. It's worth double Coinbase at this point, I think.
Is it really?
Doesn't make a ton of sense when you think about it in the right context, but the long term of how a bull cycle manifests over several years versus the short term of how a token launches, gets shorted by the wrong people, and then people long it and run over them, forcing them to buy back. Those are two different things. And so my idea of how this Aptos run has come about is like mostly people are offside shorting it, people are longing into it, trying to take out their stops and force them to buy back higher. And it makes sense within the context of if you are a fund that did the Aptos early rounds and you're now sitting on $1 billion of unrealized paper gains, like you're going to try to short the perp. The only question is, do you have enough collateral to withstand people longing against you? And I think the answer that we just learned is probably not.
I'm with you.
But things are expensive. Optimism is worth Coinbase. And that's in our portfolio. So glass houses don't throw stones. I ultimately think in the fullness of time, you're gonna see the flows dictate the price, and I don't think we're at a point where you can make that conclusion yet.
I want to move on to just actually as like because it was this was a subject of debate internally at Blockworks this week, actually, and this news came out. But there was a $160 million ecosystem fund that's in the injective ecosystem, or $150 million. So Pantera, Jump, Crypto back, $150 million injective ecosystem fund. And there was a period of time, actually, to your point before, where it's like every week there was a new $150 million, $300 million like ecosystem fund for these different L1 sort of ecosystems. And this wasn't, it's worded a little bit confusingly because it's not like there's money. It's not like Jump and Pantera just like deployed a fresh $25 million check into this fund that Injective's going to use. So each ecosystem fund is frankly a little bit different in the structure, and they're kind of opaque. But can you talk a little bit about like ecosystem funds? Like when you hear that word, what do you think about these things? Like how do they typically work actually?
So the fine print on most ecosystem funds is that, to your point, it's not US dollars sitting in a bank account, or at least I wouldn't assume that. The vast majority of ones that I've seen are more than half the native token of the ecosystem, plus some money from outside investors and some sort of handshake agreement that they're going to get the first look at any project that comes out of it. And it can be used for venture funding. It can be used for liquidity mining in the case of AVAX. But I think the common thread is that they're mostly tokens. This isn't like real US. I remember when Avalanche had like the $1 billion, I forget what it was called, fund, like Blizzard or something. They had the cool snowboarder graphic.
Actually, it was a pretty dope graphic.
It was a cool graphic.
Yeah.
But I haven't seen these things work very well over the long term. There's something about like the nepotistic, like we are the chain, we are also the fund, we are going to incubate the projects, where like if it's too self-encapsulated, nothing ever really breaks out into the mainstream. It just becomes this echo chamber. So we'll see how it does, but I think generally I'm just happy that we're putting points on the board with new funds, new capital, new ways for entrepreneurs to do what they're doing. What's up, Yano?
What's happening?
Thank you for gracing us with your presence.
Yeah, really nice.
I wasn't going to join until I saw that Vance got a new headshot, and he's looking pretty dapper in it. So I figured I'd join you guys.
My comms guy, he sent that to you. We've been going back and forth on whether I look
pretty sharp.
Cool enough.
You and Michael have like similar look. I know those were taken on the same day, same photographer. I've been there, man. I've been there. It's okay.
We did that too.
The first headshots that Michael and I ever did, we went to this place in Oakland, this fake brick office.
I remember that. It was in the Forbes article about you guys. Yeah, I remember.
And the guy was like, "You two are like so awkward that like, do you want like a drink or do you want me to like start playing music?" And it was like an absolute gong show of a 2-hour session. Like at one point, I was standing on a table
really
so
well.
I could be the same height as Michael, and he did not like that.
That's awesome.
That's how do you like that? But we were just talking about ecosystem funds and all that good stuff.
Oh, Mike loves ecosystem funds.
I was telling, it was a subject of intense internal debate at Blockworks about, we decided not to cover this particular fund for, it's just, they're a little bit, they can be misleading sometimes in the way that they're announced, honestly, or portrayed.
Do you want to ask the specific questions of like, what's it comprised of?
And they were unwilling to answer that specific question, so we ended up not covering.
What does that mean, Vance? What would it be? What are you looking for there?
Like mostly tokens. Like $150 million fund based on the private valuation of X protocol marked at its highest and last round.
Oh, so you could have a $200 million Aptos ecosystem fund based on Aptos at $15 right now, and it's all Aptos token. I see what you're saying.
Yeah.
Right.
Yeah. The key is to announce your ecosystem fund when your market cap is the largest, so people think you're big and scary.
Right. And then the other question is, where are those specific tokens coming from? And oftentimes, like the investors that are participating in the ecosystem fund, it's like, hey, there were all these investors and they were going to have their unlocks at one period of time. So sometimes those unlocks, instead of just unlocking into the wild, are put into the ecosystem fund as well, which is another little way sometimes those things end up happening.
Some fancy footwork.
Yeah. So,
good for them for going there, even if
I
it
agree.
is all tokens.
I
You're willing
agree.
to put something up and fund people? You're cool with me.
I agree with that. I agree. Let's talk a little bit about, I don't know if you guys saw, just speaking of unlocks. dYdX actually had a pretty interesting move. So they announced that they were doing the opposite of an unlock. Actually, they had a big unlock that was scheduled for January, and they pushed it back. It was $282 million worth of token unlocks that they pushed into the future. And that's going to be, so that it's going to start in December 1st, 2023 now. So basically at the end of the year. And then there's an unlock schedule, which basically like 30% of the unlocks happen on December 1st, 2023, then 40% in equal monthly installments, first day of each month, January to June, then another 20% from June till the end of the year, and then 10%, from July 1st, 2025 to June 1st, 2026. So basically they kick these unlocks, way down into the future. And dYdX kind of exploded higher. It was up like 20% on the first day that this was announced, and it's since been doing pretty well. I can without trying to put words, like our analysts are on our research team are pretty excited about dYdX overall. Like on-chain perps are a pretty interesting use case, especially right now. Like there are just so few dApps that people are actually using. Like you can always count on the 24-hour casino to attract some amount of users, and decentralized perps are a pretty good way to do it. Even if you just look at like cumulative volume of dYdX versus, which has been around for like 5 years, I think Antonio's been building that, versus like GNS and GMX, or Gains Network and GMX. I think dYdX has done like $800 billion cumulative in terms of volume, and combined Gains and GMX have done just a fraction of that. So I don't know if you guys saw this move to delay the unlocks, or if you had any thoughts on it.
I don't have thoughts about the delaying the unlock. Maybe Vance does, but I also I get why people are so excited about dYdX. They did. I don't think it's about the unlock as much as it is about like they're one of the best like app tokens right now. They did 350 million in revenue last year, and they're about to turn on revenue. The revenue return is about to be implemented this year. Not guaranteed, but from what I've heard. And they launch V4 coming soon. So like, I don't know. And they have some pretty big catalysts coming this year, like the returning the revenue, launching V4. I think it's it's an easy buy for an institution who's looking at DeFi to be like, all right, they have revenue. They're going to do like dividends back. They've got a massive TAM, low float, only one unlock this year in what I think it's going to be February now. So I see why people are so excited.
I think you're going to see these teams slowly put things together. We're turning on the revenue. We're launching the app chain. Okay, like crypto and speculation and DeFi are like the most endogenous use cases to crypto. Like we don't need anything else to happen for those things to be popular. And I think you're going to see teams put it together. And it starts with, what is the token doing? And like dYdX's token has always been a sideshow, but they're going to put together the pieces to make it work. They're going to direct revenue to the token. There's not a lot of these, but the signs of them putting it together is really encouraging. And we like it.
Vance, I've got a question for you as a VC. When these protocols talk about returning revenue to token holders, what are your thoughts about that?
Don't until the last second. Like most technology companies don't return any revenue, any dividends ever, let alone like in the first 3 years. And that's because you're trying to capture this massive market that you believe could generate substantially more revenue if you internalize it and use it wisely in the beginning. And that's what I want all of our protocols to do. Like, who cares about them giving people 1%, 2%, 3% in the bear market? They can go buy T-bills if they want that. I would just say don't return money until you have like a massive scaled protocol that's fully decentralized. And frankly, because of securities regulations, a finished product. I'm not a huge bull on governance at all. I'm a bull on no governance and just like a finished product. And that's what I ultimately want to see from these teams. Something that is beyond the reach of any sort of reproach in terms of securities, but also able to generate massive revenue and give it back to token holders at scale. I'm just simply not interested in a protocol that's worth $1 billion that's returning $10 million a year to token holders. Just like not interesting.
I'm 100% with you on that. Yeah.
Hard agree. Yeah.
Hard agree on that. It
and
just doesn't
the
make
peanut
sense.
gallery will always want the fees. Even when they're faced with, we will shut the product down if we can't get revenue into the treasury. Like they'd rather have 100% of zero. I'd rather have a much smaller percent of something much larger.
The next story I kind of wanted to get your take on was I know, Yano, you were talking about this a little bit earlier today, but this is Circle's announcement. So Circle's, they're launching Circle's cross-chain transfer protocol. So the background is they released this week developer documentation for CCTP, as it's being called, or it was this weekend, I guess. It aims to be a permissionless on-chain utility that can burn USDC on a source chain and then mint native USDC on a destination chain. Circle will serve as the ultimate source of truth, serving as the minter, burner, price oracle for USDC. They're not calling it a bridge, and I guess there is a difference between most bridges, which are like you lock and then mint, and this would be burn and mint. And the key difference here is that Circle, it's only one asset. It's a one asset bridge where Circle happens to be the issuer of the native asset. So it's pretty interesting. I mean, I think there's definitely a desire in these different ecosystems for there to be USDC natively. And I know it's been a pain in the ass for Circle to launch on like Ethereum and then have to figure out if you want USDC on Solana or wherever else, or in Cosmos or wherever else. So it seems like it is a pretty big deal, but I'm curious to get your guys' thoughts.
Yeah, I'd say bullish Circle, bullish DeFi, brings liquidity, like helps assets move across DeFi much smoother. Bearish for other bridges. I think I don't think anyone's I don't know who uses a bridge when you can just burn USDC on chain A and then mint USDC on chain B, except if you're like a decentralization maxi or if Circle is forced to KYC, it. So like, I think it's smart that they're calling it a utility, right? Like bridges had like 2 billion of hacks last year. So obviously people think about bridges now, they're really scared of them. And like, but bridges, like the UX experience of bridges sucked. It was like you had like Axelar USDC and then you had like Wormhole USDC. It was like a total nightmare dealing with
10 different types of USDC on Solana and all that stuff.
Like just a nightmare.
It's awful.
I don't know. I think it's a great product. I like really tip my cap at Circle here. The like counter argument is that they are the minter, the issuer, the like source of truth, and like that's kind of like anti DeFi, I'd say. But I think it's a great product development.
I think we're going to see people use bridges less in the future. I think what we're going to see, instead of like the plain vanilla transferring USDC from one chain to the next chain, okay, I'm now on this next chain. Now I'm going to go do this thing on this next chain. And then I'm going to go withdraw it to, the original chain so I can go cash it out. I think what you're going to see is these interoperability protocols that are not just, asset specific, but they're more about moving data and relaying transactions. Where, you're on ETH, you need a bridge to Optimism, buy an NFT, and then figure out how to sell it and bridge it back. You're going to be able to do that in 1-2 transactions. And I think this will be part of a larger, interoperability stack that really makes like the concept of like switching from one chain to another just not make a lot of sense to users. That's where I roughly see this going. There's always this like, oh my God, this is the new thing. And this is going to be the new way that we do it all the time, forever and for all time. But it's usually like, okay, this is like a stepping stone towards something that's a little bit more seamless from a user experience. And I think that's ultimately where we're going. But we haven't seen the death of other bridges. I think we've seen like more of a rearrangement in terms of like what they're going to do and what they're going to be useful for. And like the plain vanilla bridges, like, things like Hop, I think those are going to be challenged just because we've looked at 70-80% of the monthly volume of transferred assets is either USDC or ETH, where there's a native, ETH bridge.
That's what I think is kind of smart about this. It's just like if you just look at, instead of trying to be a bridge that you can send like, if the scope of what you're trying to achieve there is like be able to transfer any asset across to any other, like from one L1 to another, it is very technically complex. Whereas if like 70% of the volume is going through this one asset and you can just win that one asset, it kind of reminds me of the compound strategy of just trying to, instead of being able to deposit like any type of collateral, people just want to get leverage on their dollars. Like people just want to borrow and lend in dollars. Like, so just get maximum capital efficiency, get the best rates for USDC.
Tell you what, we are scared shitless of using bridges. And we will only use ones that we've done our own audits on. I'm glad to see something safer come to market because I think we probably lost a few $1 billion of customer assets in bridges last year, none of which we invested in. By we, I mean the proverbial we of the industry, but not a great look either way.
So I don't know if you guys saw Antonio, the founder of dYdX, responded, very quickly to Jeremy Allaire when he tweeted this out. But he said dYdX would be they would use this basically instantly starting day one when they make their transfer from Starknet to, their own protocol, their own chain in the Cosmos ecosystem. And this was like, there was an announcement of a general asset issuance chain, which I think is called Noble now is the name. And Circle's going to leverage that basically to mint USDC, which then with IBC, through the Cosmos hub, you can basically have Cosmos native USDC. And that's kind of interesting because for Cosmos applications, there's no native token like there is in ETH. Like you have to use ETH to mint or like to burn like gas fees and stuff. And if you want in a Cosmos chain, you could actually use USDC, right, to pay for things. Or if you're dYdX and you want to reward your user, they have like a whole bunch of trading rewards, right? That's a huge part of their token allocation. You could actually pay your users in USDC instead. So it's kind of it'll be interesting, honestly, to see what ends up getting used there.
When are we going to stop calling it the Cosmos ecosystem?
I don't know.
The Canto ecosystem?
Yeah, I've asked. I don't really know. I haven't looked into what Canto is at all.
Our analysts literally bridged assets over into Canto before some of the devs at Canto bridged their assets over. They were literally, if you they were look at the chain, they were the first dollars into Canto. I was like, guys, because I remember that over the summer them telling me about Canto, and they're like, yeah, you definitely shouldn't do it. None of us are going to get our money back. Once you bridge over, you can't. There's no way to even get it out right now. I was like, honestly,
that's how you make it.
I'm not willing to take those risks.
At this age, I mean, I like your analysts a lot. There's always like 3 of them whenever I'm on a call with them. It's like they roll in packs. Exactly how I did it.
So Vance, we just had our offsite. We just had our offsite in Savannah, and they moved together. Like they moved as a herd.
No, they roll together.
You might have like a tape where, we're like, there are different presentations given at the company, and like, we go to a bar, we go to a restaurant, different teams sit together. You have like a salesperson sitting with a marketer, sitting with like, like a developer or something. The analyst, you just look at a table, it's just like 8 analysts. And
nobody wants to sit with that energy either. Because what they're talking about?
They got roasted.
What other bridges can we ape to get into weird places? Like, I love it.
There's no like at that table. There's no like, how was your weekend? Like, what game are we watching this weekend? It's like degen only.
Let me take you on a different path. So you know who Andrew Tate is, right? We all know who Andrew Tate is.
Yeah.
Mm-hmm. Wow, really a different path here, huh?
Yeah. I'm not sure how these are going to bridge together. But,
so I looked at, it's going to tie. I looked at like Andrew has a thing called Hustlers Academy, which is kind of like, we'll train you to make lots of monies and get like a cool colored Bugatti.
Mike's a member. Yeah.
Mike's for sure a member.
I was the first one. As like our analysts were into Canto, I was the first one for top 10. Yeah.
So he's got like 3 careers that he'll train you in. You like enter the website, you enter the flow, and it's kind of like you have to pick like a guild or like what you train in. The first one is drop shipping. So, like somebody orders a fancy soap, you order it from Alibaba and you send it to their house and like you don't have a front end. Like that's one career. The next one is, I think you can describe it as like multi-level marketing Ponzi schemes. Okay. And then the third one is like, we'll teach you how to trade crypto. Like those are the 3
Wait,
tools
but I saw that he
toolbox.
actually nailed a bunch of calls.
Oh, he nailed a bunch of calls. He called the bottom on a live stream. He called the top in October 2021. Like he's like pretty, but I thought it was funny. It still is. If you're trying to make it, Andrew Tate's telling you it's one of 3 options, and the other 2 are drop shipping and Herbalife. It's pretty compelling to your analysts, who are aping these like obscure bridges into these obscure chains. I can see why.
Can you imagine how embarrassing it would be if like that, his like the list of people that were a member to that ended up getting leaked? Can you imagine that? Like that would be brutal. And if you were like on that, like let's put it like this. Would you rather have it leaked to the world that you were a subscriber to like 10 OnlyFans accounts or the Andrew Tate or the Andrew Tate like self-help little club?
Listen, I used to subscribe to Willy Woo Substack. That would probably be the most embarrassing of the 3.
Oh man, I bet I've subscribed to some embarrassing stuff back in the day, back in my self-help college days.
There's always that moment where you're like coming out of college, like 23, 24. Man, am I really going to work this corporate job for the rest of my life?
When I was like 19, I read a lot of like Rich Dad Poor Dad, Robert Kiyosaki.
Oh yeah.
Think and Grow Rich, Napoleon Hill,
Oh
I think it was.
yes.
How to
Yes,
Win
sir.
Friends and Influence People, like those,
Yep.
those books. Like that, like 19-year-old me ripped those books.
The worst self-help book is The Game. I don't know if you have any friends that read that.
I never it was
What is this?
in that group, but I never read it.
If that's how you talk to women, if that's how you learn how to talk to women, like you're gonna have some big problems later in life. Like you may turn into actual Andrew Tate at some point.
Oh, is this the like pickup book? Is like
Yeah,
the
like-
pickup artist type thing?
And
Yeah,
they're
Neil
just
Strauss.
like, they're like the concept is like, okay, like all women are the same. This is how you should approach them. You should like act like an alpha male and like kind of a dick. And like the people who've read that, it's like you can't really bring them back.
Yeah.
It's
Yeah, once you go full like The Game, you never come back.
you never come back. But I think to the original point is like the Hustler Academy is filled with guys that are trying to make it, and those are your three best options according to Andrew Tate.
I was
There's not a lot out there.
I was listening to a podcast. This is like a legacy podcast I still tune into every now. It's hosted by these two people that like don't know crypto, but actually I like this podcast a lot. It's Pivot. I don't mean to shit on either of these two. I like Kara and I like Scott Galloway, and I've been listening to it.
Oh wow.
Yeah, I've been listening to it for years. It's like my like guilty pleasure thing that I listen to. And Scott was on the board of he's on the board of Ledger. He was describing, he was like, yeah, so people are buying up our wallets, and I keep urging the founder that the future of crypto isn't in these NFTs or anything like that. It's in, storing digital assets like healthcare records and supply chain material. And I was like, I cannot imagine Pascal listening to that on a board meeting. I want to.
Pascal's like, get this guy out.
Thanks, Scott.
Board
We'll
meeting.
get right on that.
Thanks, dude. 100%, Scott. I'm with you on that. I'm Scott, big fan. Yeah, but I don't mean to be mean.
It's like something I tweeted today. Like people are obsessed with like these like real world use cases where their mother will be able to use it and their grandmother will be keeping her health care records on that. There's just like, guys, we're like building a large crypto economy and you're focused on like putting these things on chain. Like what types of revenue are they going to generate? How are they going to be reflexive and have a flywheel? I don't know. I kind of think we're in this like purgatory where any use case we come up with will be declared as like not a real use case. But that's how people get sidelined.
It's interesting trying to talk to someone who like, there are people that, like the majority, a lot of people came into crypto in the last 24 months or something, and all they knew was the bull market before this. And now this is the first iteration of these like real world use cases that they're seeing. And it's like very compelling to people who've been in crypto for like 2 years, because it's like, oh, okay, like dog coins aren't really going to be a thing. And they're like more skeptical in their head. And they're like these real world use cases of like tokenization and real world assets, which there might be some merit to real world assets. I haven't really made up my mind, but like, it's basically just a rehashing of like blockchain, not Bitcoin, and enterprise blockchain, and like a lot of that stuff.
Same thing
It's the
every
same
single
thing.
time.
Yeah.
And Coinbase and Brian Armstrong have talked about this, where I think after the 2014 or 2015 run, they were kind of down in the doldrums. Their exchange wasn't generating a lot of money. And one of their board members was saying, you guys need to pivot to be, and this company doesn't exist anymore, an R3 competitor, which built private blockchains for people who literally never use them.
I remember R3.
Remember digital assets with Blythe Masters as well?
Yeah.
Masters.
Yeah,
Oh,
for
yeah, I
sure.
remember them well, yeah.
Like,
Yeah.
how are those things going? They did not survive. They did not find product market fit. They were staffed with the smartest people in finance. And the reality is like, those are interesting enterprise SaaS businesses, but like, that's not the movement. It's not the revolution. It's not like what we're trying to build. It's just not that big of a market.
Yeah, I agree. But the point that there are also like outside of that on Pivot is like that, and this is, I actually do kind of believe this as an idea. It's like the ultimate buyers of these things, like the reason why Bitcoin and Ethereum and like crypto is so compelling to a younger like millennial or Gen Z type generation is because if you talk to like, especially Gen Z, there's this idea that like the system, like we're already fucked. If we try to do the thing that our parents did or people that are older than us, like buy stocks, like you're not going to work, never going to make it. So we need to do something else, something that's like higher risk, higher volatility, like higher convexity kind of. And like crypto is that thing. And I think I buy that argument because I also think like that a little bit. Like there's a part of me where it's like, yeah, dude, I'm not going to like make money buying the stock market right now. Like, look at it. It's ridiculous.
I think it's different now too because of social media. Like, what do you see when you go on Instagram? Models and private jets and movie stars and rock stars, and everyone was brought up with the idea of like you too will someday be one of these people. But there's a lot of daylight between the average person and getting to that level. And so it's logical. You know, you didn't have that mirror of pop culture 20, 30 years ago that was instant on demand. Like, if you're living in New York, you probably didn't even know what was going on Los Angeles. Like, now that culture, the movie star, you know, big life, that's everywhere. And I think that's what people are all aiming for just because of social media. So I think it's now like that more than ever.
Yeah, I think so too. Social media is a tricky thing. I know I have a lot of conversations with my dad about this, who like ascribes a lot of the ill in society to social media, and I've kind of defended it for a long time.
Mr. Ippolito.
Can you imagine
the
that?
damn social networks.
Yeah.
I'm just kidding. I do love your dad.
that.
And I think he's right. And I think he's right, by the way.
I increasingly,
he's
I've
right.
defended him a lot, and I increasingly think he might be right.
No, I'm completely on his page too. Yeah.
You go on Instagram now, it's just trash. Like,
Trash.
you know, like it's all like, it looks like a chat GPT-3 instance took over the internet and it's just like all models and movie stars and like, you know, cool houses, and it's so
You guys
toxic
should watch,
that
you guys
everybody
should watch
wants
the social dilemma on Netflix. You will, if you're not already convinced that social media is horrible, you will delete Instagram from your phone immediately.
I deleted it. I deleted
deleted
Instagram
too.
and Twitter. Haven't had them for like a year.
I haven't
That-
had Twitter and
that's
Instagram
alpha.
on. I also haven't
All-
had Twitter and Instagram on my phone, and I don't have any social media on my phone actually.
If I need to tweet something, I need to go sit down at my computer, open the computer, take a breath,
Me too.
type in my
too.
password, you know,
Yeah.
tweet.
If I have Twitter on my phone, it is endless scrolling. So I just don't have it.
Yeah. That's, you know, all you really need to know is that all these like these execs at Apple and like Facebook, they don't let their kids use it. They like limit their kids
talk
from
about that in
using
the
it. That's the
documentary.
only thing you need to know.
Would you let
honestly.
your kid buy crypto?
Why wouldn't you?
100%. Yeah.
Exactly.
You know what though? There was like it's not totally binary either. I mean, there was like, we let people smoke cigarettes even though it's bad for them. But like someone has stepped in and be like, yo, you like can't inject this shit right into people's veins. Like you need to like put a filter on that, you know, like you
Don't
can't
market
use
it to kids.
You can't
Yeah.
use this chemical. You can't market it to kids. Honestly, we might just be living in the part of society before they introduce whatever that equivalent is for social media and phones and all this stuff.
The
Like,
TikTok ban bill is out today as of,
Yeah.
I think it's Senator Josh Hawley or something.
Holly.
So like we're getting there, you know?
yeah.
That used to feel like the cardinal rule of like America, like, you know, capitalism, do whatever you want, but like don't fuck with the kids. They're the future. And now it's like, okay, like we're finally getting there to the point where we've realized these things are semi-poisonous and we probably need to curtail them. So I think it's really good.
Benioff called Facebook the new cigarettes like 3 or 4 years ago. And I actually remember listening to it at the time and be like, what are you talking about, dude? And now I'm like, yeah, he has his own reasons for saying that, but he's probably more right than wrong, I'd say.
Most people can identify the point in their lives where they started using social media, and there's kind of like the before and after. That's probably not a good thing.
I agree with that. You know what else? Just last point on this topic. Have you guys ever heard of a movie called Eighth Grade?
Mm-mm.
Okay, watch Eighth Grade. Eighth grade is it follows like a girl who's in eighth grade basically, in like, you know, and it's just, dude, it's pretty depressing. Because do you remember being that old? Like you were super young and in middle school, and like I don't know what you guys did at that period of your lives. Like I played a lot of Xbox. I had no access to any of this stuff then, and watch her experience. Like it's Bo Burnham. Bo Burnham did the movie. If you guys know who he is. No?
My plan was to become a professional skateboarder. That's what I was
really?
aiming for at that point. Yeah. Didn't work, but we found something else.
There's just 2 stories that I want to get to before we jump. So something happened earlier this week with Stargate Finance. This is kind of funny, but it's also indicative of a bigger problem. So this got posted in their governance forum. The Stargate Foundation has been approached by an individual representing that he works with a family office that is looking to acquire $2 million of STG at market price from the Stargate DAO. As this is the first time this has happened, this issue is being brought forward to the Stargate DAO. Should the Stargate DAO complete this transaction, selling $2 million worth of STG, priced as a 3-day time-weighted average price TWAP, for USDC. This USDC would then be used to purchase ETH that is locked in Stargate POL and supports Stargate liquidity on Ethereum. Assuming a target APY of 5%, this would reduce STG emissions by 100,000 per year and strengthen Stargate's permanent liquidity. Blah, blah, blah. Basically, like, we just want to let the community know. Fast forward to 2 seconds later, Stargate pumps from 47 cents straight up to 69 cents. That's really funny. And it's just like, obviously, everyone front ran this when, you publish that there might be a huge OTC buy. So one that's kind of funny.
Unless it's Psyops and the family office already bought, and then that was their way to pump it.
It could be Psyops. Yeah. But how could they, like, I don't know what the liquidity is on Stargate. I would guess it's super thin. So I guess this would reflect poorly on Stargate, or I guess maybe the family office somehow sourced the liquidity outside of this, or I don't know how they would have done that. But you're right. It could be Psyops.
Probably not Psyops, and probably they just got front ran, and this is a good lesson in governance, though.
Like, let me just ask you, because we've talked about this in the context of, like, not airing dirty laundry necessarily. Like, sometimes you see these really personal, like, work feuds that get aired out in governance forums. What do you think is appropriate? How much should be kept behind closed doors because it's frankly better for everyone involved versus what are things that should be run through governance?
Most should be kept behind closed doors. I don't think the idea of a DAO needs to be like transparent everything, and every decision goes through like public. Like, I think there's this idea that DAOs have to have everything 100% transparent, and DAOs have to have every decision made by a committee. And I think both of those things will be seen as like a remnant of like the early days of DAOs. You can't build good companies like that.
I agree with that. I agree. Especially HR issues and stuff. I mean, that doesn't serve anyone.
No.
Why would you want to know?
No.
Yeah. But this is a good reminder too, like, also why there's alpha in governance, and it pays to pay attention to this stuff every now and again.
I think the most alpha in crypto is in governance right now.
Yeah.
Yeah.
There was something else. We didn't really want to talk about it on this, but there was a curve pumped because basically Aave was unwinding the impact of some bad debt that was in one of their curve pools, which is courtesy of Avi Eisenberg, RIP. And this also went through the governance forum, and Curve also pumped because basically Aave bought back a bunch of Curve. So you can pay attention to this stuff, and it actually is very helpful. Last thing I wanted to get your take on, because I know you've got some thoughts on this, is just is Doodles moving over to Flow. So the background is on Wednesday they announced that Doodles 2, which was premiered back in June, is going to launch on Flow. Doodles 2 is to span millions of NFTs instead of the 10,000 avatars in the first Doodle series, which I actually think is very interesting. Core Doodles collections were made on Ethereum, so that's not changing. This is just Doodles 2. But basically the founder posted a thread for why they chose Flow, which has to do with kind of it's almost like the customer journey for signing up and getting an NFT. So you can just create a wallet really easily in Gmail when you use Flow. You can buy wearables with your credit card in a couple of clicks. No transaction fees. So there are some like legitimate reasons to using Flow. What's your sort of thought on this decision from Doodles?
It's a big risk that I would disagree with, but I could be wrong. And I think basically what they're doing is so you have Doodles Core, which is like the 10,000 doodles. And those, I think my understanding is they're staying on Ethereum. And then there's like Doodles 2, which are going to be like millions of doodles. And those are moving over to Flow, or those will be built on Flow. I think that they're basically jeopardizing their core audience for this like hypothetical and like potential massive TAM audience, and which is like normies, who like use Flow because it's super easy to use and it doesn't feel like crypto. And like every time I've seen that strategy over the last 4, 5, 6 years, it's never worked. But I get how the decision was made, which is like today we're just this 10,000 PFP crypto thing. I think there's actually a broader problem here, which is like Doodles raised 54 million or 50 million at $700 million valuation. They have to grow into this valuation, right? If you raised it 700 million, they have to make if they want to get a 10x, they have to become a $7 billion project. So you don't do that by staying as a 10,000 PFP collection that's like just held by crypto people. So like this is them needing to take a swing because they raised so much money at such a high valuation. And like I think that's why they're moving over to Flow. But like, I don't know. Flow is like is the lead. Like I never hear about Flow. Who uses Flow? Like Top Shot is dead. They did a big thing with Dr. Seuss. I don't even think that got off the ground. And like they created nice IP with like NBA Top Shots, but I haven't heard about that in like a year. And also they built a completely permissioned. It's not DeFi and it's not like a permissionless crypto platform. Like it's a completely walled off garden, which I think like, I don't know. I would assume what happened here is Flow went to Doodles and they, most of the Doodles team came out of CryptoKitties and most of the Flow team came out of CryptoKitties too. So what I would assume happened is like they're close friends. Flow went to Doodles and like, I'm sure they gave him a decent chunk of change to go move on to Flow. And that's fine to happen. I just probably disagree with the decision.
One thing I think is kind of interesting is the decision to launch Millions. So I don't know if you ever read or listened to any of the interviews by Gabe Layden, but he kind of has this idea that most people will get their first exposure to crypto through an NFT. And he has this whole thing about free to own. There'll be free NFTs and then I'll make you sign up for a wallet and like that'll be the Trojan horse. I do think there's this weird thing that's happened with the initial Punks collection. Kind of picked an arbitrary number of punks out of thin air when it was unclear that any real value would accrue there. And ever since, everyone's just copied this 10,000 number for no real reason. And what that's given rise to is just these like whale community. It's just made NFTs like a whale game. And the whole NFTs, all you do is you find a mint that that you can be early to. You mint the NFT, you either flip it or you hold on to it when you can become like a whale. And it means that there's like no sustainable revenue model for NFTs. And if you look at Yuga Labs, all they do is just find new ways there's like the secondary trading fees, and then there's minting, like new primary sales of NFT. They're just primary selling this, primary selling that. And I think the way that you open up your base to a broader number of people and therefore increase transaction revenue is to have larger collections of less expensive NFTs. So maybe Doodles is doing that. That would be cool. But I don't know that that's their strategy. So I'm with you. It's kind of it feels a little bit weird, to be honest, this move.
Yeah. I don't know. I'm also like, I just don't know who else is built on Flow. I don't know one other thing built on Flow. So
no, me either. They got to open. I know they have plans to open up and become permissionless, but if they did, then I would be more excited about it and kind of change my mind.
It's like liquidity rules everything in the NFT space. And there's no liquidity. There's $6 million of like NFT volume on Flow in total. Like users don't want to store high value NFTs on Flow. So I think you'll see these like the good doodles will stay on ETH, and then the bad doodles go to Flow. I don't know. It just doesn't feel like a good strategy.
Yeah, I agree.
Yeah.
So, all right, buddy. I think any other stories, anything else you want to catch up on?
No, that's about it.
It's funny that we
Pour one out for Kevin Rose. He got hacked, $2 million.
That sucks. Poor guy. Yeah. Honestly, big fan of that guy. And if he's not safe and he's getting hacked in this space, I'll be honest, it makes me feel a little bit nervous as well.
One thing that everyone needs to do is just have two wallets. You have a wallet where you hold your valuable stuff, and then a wallet that you use to interact with smart contracts. Like no ifs, ands, or buts. Everyone should have that. And he didn't have that. He had all of his NFTs in one wallet. Probably the reason you do that is like either laziness or like to flex, to show like I've got all these NFTs in this one public wallet. Like look at me. And like this is what happens when you have all your stuff in like this one valuable wallet and you're interacting with smart contracts. So like what I do is I have a wallet that like never touches anything, never touches smart contracts. And then if I want to like mint or I want to sell something or like interact with the smart contract, I move the asset over into that wallet.
I know. Let's give him the benefit of the doubt and say, I don't know if it's about, maybe he's just very active. That's a huge pain in the ass, what you're describing. That system is a gigantic pain in the ass. So,
I pour one out for him for sure. I feel really bad for him. I'm just saying, I don't think I just wouldn't have $2 million in a wallet where you're interacting with smart contracts. And that's not on him. That's on the industry to like, I don't know. There's got to be a better way to do this. I don't know the better way, but like, I feel like MetaMask could give a flag being like, this is a bad contract. I don't know. I don't know the solution.
I don't know. No, I'm with you there.
Yeah.
All right, buddy. I think we can close that. I love how you missed the crypto stuff in the beginning and just came.
I just came on to talk about social networks. Yeah.
About social media. I you know what? I've drank the Kool. I think it's after like a long time defending it and maybe trying to be too contrarian for my own good. I think they're pretty bad, and I'm not.
Me too. I'm going boomer on it. I agree.
I'm going boomer too.
All right, partner. Good chat.
Peace, buddy.
Peace.